Time now for Smart Charts with Abigail Doolittle, who is standing by right now with that. Abigail?
Well, Romaine, thank you so much. And before we bring in one of our frequent Smart Chart guests, Wald of Oppenheimer, I would like to take a look at a chart that I almost fell out of my chair looking at when I first discovered it the other day. And it's a long-term chart of the Bloomberg Commodities Index. When we go into the Bloomberg terminal, it basically shows a 50-year topping pattern. Now, on air here, the left side is not showing very well. You often will see a topping pattern of this nature on a shorter-term basis and not for an index. But this pattern, if it stays confirmed, suggests that there will be another 70% drop after the 75% drop from the 2008 lows. Really not a risk-on chart, not fitting the rally that we have for stocks. And now to talk about this pattern, I can't think of a better person to chat with me on this very, very bearish chart area, because you have been very bullish over the last few years correctly. And so I'm curious to see, what do you think of that chart and how does it fit into the stock market rally right now before we take a look at your S&P 500 chart?
Well, Abigail, it's a very important chart, and here's why. If you look back at how commodity prices acted during the S&P's last secular bull market between 1983 and 2000, this index made zero progress through that entire 17-year period. Same thing with the 1950s and 1960s. So it indicates the stock market likes low and stable commodity prices. So we don't see it as a topping pattern. We see it as the lower end of the range, and some stability here would support what we see as a market recovery.
Okay, so that's great. So you do not think that that is going to produce another downfall. But on the other hand, you think that the stock market will probably like low commodity pricing, as you were just saying. So now let's take a look at your S&P 500 chart, because I think you're saying that we do have a major low in place.
That's right. When I was last on the show, March 25th, we made the case that the collapse presented an opportunity for long-term investors, and that's still our focus. The reason is because there were over 1,300 new lows on the New York Stock Exchange in March. That's the second highest count ever, looking at data going back to the 1940s. Abigail, if that's not capitulation, I don't know what is. So that's why we think that was an important low, and our focus remains on what looks like is becoming a new bull market.
Well, before taking a look at your last chart of the Russell 2000, I have to ask, do you think that we test that low? And if we do, it sounds like you don't think it will be anywhere close to the lows. Would you think that maybe a 5% pullback, drawdown, or what do you think would be healthy?
I think any possibility of any sort of retest was severely diminished this week, given the action this week, and my final chart makes that point. So I think anything is just going to be a sideways pause.
And so let's now take a quick look at your final chart, the Russell 2000. The last time we were talking about this chart, you were looking for 1,600, but now you're very happy with the performance. And my gosh, up 40% from the March low.
This is why I don't think we get the W bottom. The incremental positive this week is that small caps are participating now. The Russell 2000 was hard hit through the collapse, falling below its December 2018 low. So now it's back above this threshold. This is called a failed breakdown. It's indicative of selling exhaustion. And as long as it holds, our assumption is that the floor is in and stocks should continue to be re-rated higher. So 1267, the big level for the Russell, and I think the market overall.